Welcome to How to Finance Your Business. In this module, we will explain, number 1, what type of funding do you need? Number 2, what is long-term financing? Number 3, what is short-term financing? And number 4, can you have a combination of both? To be a successful business owner, it's important to have access to funds to either launch a new venture or to keep your existing business operating smoothly. In this lesson, you'll learn how to gain funding for your business in 2 major ways. Through long-term financing options, such as using owner's equity, retained earnings, long-term bank loans, and leasing. Or via short-term financing options, like bank overdrafts, short-term loans, and trade credit to help fund your business needs. Let's say you own a busy bakery and you're making plenty of sales. You need a new $20,000 industrial oven to meet demands. You may decide to take a bank loan, but you also must decide whether the new oven will bring you more income than the total cost of the funding. For example, if you receive a $20,000 loan with a 10% interest that costs you $22,000 overall, your new oven should bring in more than $22,000. Also, you shouldn't use any business financing for personal items. Ask yourself these main questions. Number 1, why do you need the money? Number 2, how much money do you need? Number 3, where will you get the funding? And number 4, will you use long-term financing, short-term financing, or a combination of both? Let's begin by taking a look at your long-term financing options. When seeking the $20,000 funding for your new oven, you may choose to use long-term financing, meaning any funding that will take you more than 1 year to pay back. There are 4 main types of long-term financing you might use: owner's equity, retained earnings, bank loans, and leasing, or a combination of several of the choices. Number 1, owner's equity. As owner of the bakery, you could use your personal money to fund your purchase needs, increasing your equity in the business. You could invest $7,000 to fund part of the oven's cost. The downside is that it can be a great personal risk and might take some time to get that money back out of the business. Number 2, retained earnings. Retained earnings are the part of your net profit that is reinvested back into your business. Using retained earnings can be a good way to fund your business because you're not taking on additional debt and do not have to pay interest. The risk is that you now have less cash in the business and you may need that money for an unexpected expense or when the business is slow. Number 3, long-term bank loans. Long-term bank loans are an important option for obtaining business financing, but your business must qualify to get this funding. This option is great for purchasing long-term assets and has lower interest rates than many short-term types of financing. Number 4, leasing. Another long-term financing option that is growing more popular is leasing. Instead of purchasing the brand new oven for $20,000, you enter into an agreement with a leasing company and agree to pay a monthly fee, for example, $1,000 per month, in exchange for the use of the oven until it's paid off. The main benefit of leasing equipment is that you don't have to tie up a large amount of cash by buying the oven outright, yet you're still able to use the new oven and meet your sales demand. However, leasing also comes with drawbacks such as down payment and very high interest rates. Often owners will combine a number of long-term financing options to make larger purchases, such as using owner's equity for the down payment on a leasing option. Now that we've examined 4 main long-term financing options, let's put them to work for you. At your bakery with holiday season coming, you realize you need funds to buy more raw materials, as well as pay for extra help to prepare the food. You will have a sufficient amount of cash once the holidays are over, so you only need short-term financing, that is, funding that is due to be paid back in less than 1 year. Let's look at 3 ways to borrow the money you need that can be paid back within 12 months. Number 1. Bank overdraft. One of the easiest ways to get short-term financing is called an overdraft, whereby a bank might loan you a certain amount of money for a very short time. When a bank overdraft might be a good way to cover your immediate expenses, it requires a good account history with the bank and comes with very high interest rates. Number 2. Short-term loan. A short-term loan is funding usually obtained from a bank with a payback period of less than 1 year. You can choose to obtain a short-term bank loan to pay for your short-term assets, but like in the case of an overdraft, you need to be creditworthy to qualify. Also, the interest rates on short-term loans are higher than in the case of long-term loans. Number 3. Trade credit. Another way to obtain short-term financing for your business is through trade credit from your suppliers. Rather than having to pay for your materials when they are delivered, you can have a week or a month until you have to pay the supplier. Trade credit is often used to finance purchase of raw materials or pay utility bills. It's generally considered a cheap source of financing because it usually does not cost anything in terms of interest. If you're already using your maximum available trade credit, some other source of finance may be required. Let's say you have to pay for your eggs and flour upon delivery. Perhaps you can work with your supplier and see if you can pay at the end of the month. That will give you 30 days to make and sell your bread before you need to pay your supplier. Even if you're short of cash, you can still buy the optimum amount of ingredients for your bread and pay for them after the money from the sales have come in. This is very helpful during unusually busy times such as holidays. Just remember to put aside enough money during the month to pay your supplier back.